quiet. That side of the market has changed dramatically just in the last week or two at most, but in the last week. But certainly at this point, and I've got to call Altus Group, who actually they do a lot of the appraisals for the pension funds here, and they have a quarterly interview process they go through, and they collect all the market sentiment. Somehow I got on the list by mistake. It's mostly the pension fund and REIT senior acquisition people and all that they're polling. And Monday they'll be doing the call with me. I'll be interested to see the results from that. But the brief discussion I had with one of their head people just yesterday was that the market's still strong. The increase in interest rates has not hit the industrial sector yet, but there have been office and retail transactions in progress that are getting repriced because of the interest rate. And this was before I think he saw what the stock markets were doing yesterday. Go ahead. Look forward to any thoughts from someone else who would like to start out.
I could just jump in and say, as CORFAC president this year, it's to me, it's very important. And one of the great strengths of our network is that we have worldwide coverage, especially in times like these, because there is no doubt that we're living in a global economy more so than probably any time in our lifetimes, with changes in supply chain, and all of our economies from North America, South America, Latin America to Europe to Asia are very much intertwined in some fashion. So I think that having these calls and having this interaction is extremely important for our network. And I'm just talking on a general sense. It's very important to us that, and we're very grateful to have our Asian partners and our partners around the world. So I just wanted to make that statement to kind of start off from my perspective.
Thanks, Mason. Daniel, welcome.
Thank you very much. My apologies. Lunch was too good, and that's the reason why I'm late. I'm late in coming back after lunch, and Jonathan probably hasn't even had excuse me, breakfast yet.
I have not.
And, and I don't know if our friends in Asia have had dinner yet, or maybe soon. But anyway, I'm full and ready to go after a good lunch.
And I was just going to say, Ray and Mason just gave a just kind of a brief synopsis of their thoughts, as Ray related to Toronto and Mason more about the value of CORFAC. Daniel, we had talked about perhaps some perspectives from the different people on the call on what's going on in the world today. And anyway, that's kind of where we're at.
Okay, sure. Do we want to provide brief market updates, or should we talk more generally? What I had thought of it, at least on the general front, was there's a lot of talk in our market. I'll just jump in on that and sort of give a market report out and the topic at the same time, is that will prices go down? Will in particular commercial real estate prices go down now that interest rates are going up? And at least in our market, we have seen that the interest rates have practically doubled. Frankly, they were very low. It was for commercial real estate, you could get below 1%, 85, 90 basis points loans. And now we're talking about 2%. So in fact, even more than doubled in a very short period of time. I would less than a month. Well, maybe it's 6 weeks, but whatever, it seems like it's less than a month. In a very short period of time, interest rates have doubled in our market. And of course, many people are of the view that if interest rates go up, the value of real estate goes down. And there's a lot to be said for that, but I just want to reach and raise 4 reasons why that should not be the case. And I'm taking this from a podcast, which I recently heard. It was a Marcus and Millichap fellow podcast, and he gave 4 reasons as to why cap rates do not necessarily go hand in hand or step by step if in an inverse relationship to interest rates. First was, you have to look at how much capital is active in the market. And if there's a lot of capital, as there still is a lot of capital, there are a lot of people with funds still, money still to place, then that's going to mean there's demand and the supply is what it is. So prices are going to stay low. So for that reason, the view is that prices should not of real estate should not react immediately to a rise in interest rates because there's still a lot of money chasing real estate. That does seem to be the case so far, at least in Switzerland. Prices are holding. Of course, we only have about a couple of months experience with this, but nonetheless, there hasn't been a knee-jerk reaction. So what first point is how much capital is in your market? If there's still a lot of demand, prices aren't going to go down, even though interest rates have gone up. The second one is, are there alternative investments? And this fellow was saying, you know, the Standard & Poor's stock index went down 16% since the end of 2021. And therefore, that proves once again that stocks are not very stable, and real estate is typically more stable. You have leases, they're longer term, you can evaluate the credit risk. So what are the alternatives that one can invest in? And if the alternatives are volatile, then that means real estate being more stable, prices should hold. It's another reason for keeping it. His third point was upside potential. If you buy a property, you're buying it based on the revenues that are currently being generated. And if you have an idea for development or redevelopment or other enhancements or changing the purpose, repurposing, all of those add-ons obviously create value, and therefore the purchaser is willing to pay the price. And the fourth reason that he gave was demographics. As people are retiring, people are more interested in having real estate in their portfolio as opposed to other things. So a long-winded answer to sort of say the big issue in our market is, will prices drop because interest rates have gone up? Here's 4 reasons why someone at least thinks not. I'm curious to know, because I think we can learn from each other's market, and maybe not everyone agrees, but I have a theory about the weather in Switzerland. The weather today in Chicago will be the weather in Zurich in 2 weeks' time. So on that basis, I'm very interested in knowing in Canada and the United States what the market is reacting to rising interest rates. Is it going to change? Because then I'll know it's going to happen here in 2 weeks. So Mason and Ray, could we have your views on this, and then the others as well?
Mason, do you want to go ahead?
Sure, I'd be happy to.
Fine.
And Ray and I were talking a little off the cuff at the very beginning of the call here, but I agree with your sentiments from the podcast, Daniel, and that interest rates certainly will have an impact. But from an industrial standpoint, there's very little supply across the country. There's been very little speculative development in most markets, and there are outliers such as port cities that specialize in warehouse distribution. Of course, there's been speculative development in those areas, but in the heartland, there hasn't been a lot of speculative industrial development. The only real building that's gone on are build-to-suit type of transactions. So as a result, I'll tell you, in Detroit, the industrial market, our vacancy rates are 3% for industrial. And the cost of construction is going up, which also stifles any kind of speculative development. So there's still a high demand with such low supply of available product, which means most of our buildings are full, and any property that is available for sale is trading at a very low cap rate and is very desirable. The office market's a little bit of a different animal, just because of the effect of the pandemic, and we're not quite sure how that's going to affect occupancy rates moving forward. People ask me all the time, how's the office market in Detroit? And I say, well, it's 80% leased, but 25% occupied, because there's a lot of companies, a lot of businesses that are still paying rent. They still have leases, but they haven't fully occupied their space. And it's unclear whether or not they're ever going to fully occupy their space. We just don't know yet. So over the next 18, 24 months, as those leases roll over, are we going to see a huge spike in vacancy rates? We're going to see, depending on other factors such as the economy. I have a personal belief that right now it's an employee-driven market, in that most employers would like to bring their employees back to the work setting in the office, and we're getting huge pushback from the employees that don't want to come back. and they have the leverage because employees are hard to find. They'll just go get a job somewhere else if you force them to do something that they don't want to do. That might change as we enter a recession, if that does in fact happen, which I believe we are, and that the employers will have more of an ability to direct those employees to come back to the workforce. And as a result, I'm hoping that that means that vacancy rates will tick back up and people will start occupying these buildings again. So interest rates do have a factor, but there's so many other external factors that we're dealing with. This is a once in a generation, this pandemic. I don't think we fully realize the effects of this pandemic that we had 3 years ago, or however it's long ago it's been now, with, especially in the United States, and I'm guessing around the world, with all this liquidity that was pumped into our system by our governments. And we wonder why we have 8% inflation when the government pumped trillions of dollars into the economy. You can argue whether it was justified or not. And now we're trying to play catch up and deal with it. So these are unprecedented times, no doubt, but I would agree with the podcast in that interest rates have an effect, but it's probably not the most determining effect that we're facing.
Just consistent with that perspective that you shared with us, Daniel. I saw a couple of months ago now on Bloomberg interview, president of, and I think the company was in New York, real companies, something like that. But they own the downtown retail property that Neiman Marcus is in. And he commented they were converting a lot of that retail space to other use now. But it was the first time I heard that comment. He was observing that he believed it would be the textbook inverse relationship between interest rates and values would not be the case for prime properties. His observation basically was there's too much capital chasing high quality locations. And if you have, and the analogy in our market will be, people could get literally 10, 12, 14 offers on a industrial building. So maybe now they'll only get 3 or 4. What I have been noticing, I showed a little over 100,000 square foot building to a user for a warehouse about 6 weeks ago. The price they were asking seemed too high. We didn't do anything. I followed up with the agent yesterday by email. He's reduced his asking price by about, he went from $320, $325 a square foot to $270 a square foot. So interesting to see it hasn't, that's the type of property that would have sold to a user. Limited supply, high demand, but the prices just got above what people were going to pay. And that's even before the recent upticks in interest rates. So I think I was starting to sense some concern by people who were just outbidding the other buyers in the previous sale on industrial to make sure they got the property after they'd missed on several buildings and not been the high bidder. And I was sensing a little more caution or being a little more prudent. But I am seeing now some things are selling, but there's a limit to what people will pay. And that might have been even not totally related to the interest rates, but certainly concern. I commented just before he came on that one of the fellows that I talk to regularly, who's well plugged in at the institutional level, he commented that the number of office and retail projects, some of them had been repriced recently that were, whereas the industrial had not yet been affected by the interest rates. But it will be, it'll be very interesting. I'm interested to see how certainly the office pans out, as you mentioned, Mason. The office side certainly has been, there has been some leasing, and they have been getting decent rates, but I'm noticing a lot of leases as they roll out, as the mature, some spaces being given back to the landlord. Already seeing that here.
Do you still have in your market, Ray, that, as Mason said, there's a reasonable amount of office space which is leased but not occupied?
Yeah, very much so. A lot of people they're getting back to work, but it's 2 days of work or 3 days of work, or it's a percentage of the workforce. So there's some, when I drive by the office buildings, the parking lots are not very full. When I talk to people, well, yeah, I'll be in the office, but next week for a couple of days. So I do sense a lot of people are still going to spend more time, be it for the convenience of being able to pick up their son or daughter at work, or go to the dentist in the middle of the day, the work day, or just because of some of that I think is going to stay for personal convenience from what I'm seeing. And some of it will depend on what industry somebody's in and what their culture is in the office. But there's a push to get back to work, but it's certainly on a much more limited basis.
Yeah, just an anecdote to add, and then let's hear from others. On the weekend, I met a fellow from Credit Suisse who said that it's totally up to personnel whether they want to be in or not. But however, they had to come in every Wednesday. That was the deal. Wednesday was the day that everyone had to be in the office so that they could have a updating communication. They probably do that other days as well, but physically they had to be there. And he was saying that they're now going to have to take even more measures because they have people scheduling. I remembered it because you said dentist. They have people scheduling dental appointments or doctor's appointments, as he said, on Wednesdays. When if you know you have to be in the office on Wednesday, why wouldn't you do that on another day? So people seem to be taking advantage of it, and even the one day of the week they're supposed to be in the office, they're making other plans. And I think Credit Suisse will take action against that.
What are you?
Sorry, please go ahead, Ray.
No, I was just going to ask. Don't want to dominate things. Somebody else chip in. Vincent,
Yeah.
what's your current? What's happening in your world?
Pretty much the same. We just finished our national election, so we're about to elect another Marcos in our government. There's a really big push in the previous quarter when it comes to office take up. We've seen around 146,000 square meters. That was leased last quarter alone. I think this is mainly due to the focus of or the push of the government to allow the employees to return to their work. Right now, there's we're at a 70-30 work arrangement, at least on the companies that are PEZA accredited, and we're looking at an increase in demand, but in terms of vacancy, we're at 17.3%, and we're projecting it to end at somewhere between 18 to 19%, solely because of new offices that are coming online in the market. But in terms of other reasons, it's pretty much the same with you guys.
Mr. Kim, can you share what's happening in South Korea? Other than that, you're sending lots of medical aid to the north to avoid the virus coming south.
Yes, we had new president on May 10th. He is prosecute to turn the politician. So like many people are worried about how he will lead our country. But who knows? So, but yes, the ex-president, Mr. Moon, he was trying to send some vaccine to North Korea, but the party leaders opposed to sending. But now they are trying to give vaccine to North Korea. So, but I understand, and I agree with the 4 factors you mentioned regarding cap rate and interest rate. Yes, in Korea, I think the office market is very hot because of the very limited supply, and new construction will not be easy because of the too high construction costs. So vacancy rate is, I think, all-time low, about around 5% vacancy rate. But the residential market is performing not so good because of too much regulation from government side, like regulating, housing law and interest rate hike. So residential market is not so good. And industrial market is now experiencing some difficulties because of high construction costs. So some investors stop investing in because the construction cost, because of construction cost, the property value went up so huge, but the rent escalation is just 3 or 4%. So there is a gap between rent hike and some investment the value. So many investors are reluctant to investing in industrial facilities. So office market is leading the Korean real estate market, and interest rate is around about 4 or 5%. Yeah, as Daniel mentioned, the interest rate is going up double about 4 months ago, right? So I think the interest rate will impact the real estate market, but the office market will be the last sector that will experience, that will hit by interest rate. So, and I'm worrying about the trend that the deglobalization trend, because of the because of the war, Ukraine and Russia. Not war, Russian invasion of Ukraine, right? So that caused many investors worry about the investing in overseas. So I just read some news article that the Korean car makers will build factory in Korea instead of the China or other East Asian countries. So instead of offshoring, onshoring will be the new trend. Yeah, in the future. So I'm worrying about deglobalization trend. So in the case our network will be impacted too in the long term.
Mr. Kim, on balance, Korea has a number of very strong domestic companies doing manufacturing in Korea. It also has a number of foreign companies in Korea doing manufacturing. So on balance, are you saying that the foreigners won't expand or further their business and may reshore, so they're going to close down? Do you think there's enough scope domestically? Are the domestic companies going to take up that space, or you're saying that you think that rates will fall?
I'm saying that in terms of the real estate investment side. So many, some real estate investors, the institutional investors showed the reluctance in investing in overseas.
Just your comments on rental rates and all just made me think. A Japanese client of mine, Nidec, we just subleased some office space for them. The face rate on that they were paying on the office space was $16 a square foot net, plus taxes and operating expenses. We had to subsidize the rent to put a subtenant in. An industrial client on the next, just in the same business park that doing a lease with. So their lease came up at $7.50 a square foot net. That was the rent on the last year of their current term. The renewal rate's going to be more than double that, more than the office space, face rents on the office space. It's complete inverse of what I've had the last 40 years. Industrial space rents for more than office space now.
And I'll echo that, Ray. Sales too. We're selling industrial buildings for more than office buildings. It's crazy. We're selling industrial buildings for $120 a square foot. I can't get $100 a square foot for an office building.
Yeah, that's and when I comment about people overreaching on the market here, so that industrial building a year ago I would have sold at $350 a square foot is now $450 a square foot. For a small, say a 15, 20, 30,000 square foot industrial building. That's what they would, maybe not the smaller size, the 15, 20, 25,000 foot buildings. But we were well into the $300 a square foot range on a 40,000 square foot sale a few months ago. And if I'd priced that a year earlier, I would have been well under $300 a square foot on a 40,000 foot building. It just the increases have been so rapid over almost every 60, 90 days. And I think we hit a ceiling and it's now coming down.
Ray, has there been any sustained speculative development of industrial properties in Toronto to speak of? Has there been, and I can tell you in Detroit, there's been very little.
Yeah, so the larger players like the Prologis on the industrial side will buy land and build the large bulk warehouses, Panatones for the Amazon type clients, and they are pre-leased before they finish the building. They're the asking rent. They don't have an asking rent. They won't set an asking rent until they get close to completion, and they pre-leased it before they actually put an asking rent on. If I call them, I did an offer for to 110,000 foot building, did an offer for 52,000 square feet. My clients now got cold feet and backing out before the offer was accepted. But we would have done that at $15 a square foot net. The building would be, they've got the permitting all done. The building would be ready July of 2023. So still a distance off. Space in the market, right? And that would have been a good deal because space down the street is current on a new building just being finished. They're leasing the leftover 40,000 feet in there at $17 a foot net industrial space. It's just sort of, there's still a significant discrepancy between what some landlords want and others. But a lot of space is being marketed now just with no asking rent, and even small buildings, 15, 20,000 square feet, they're not even putting a rent on. So you have to call the agent for some guidance on what the landlord's looking for. And that's a trend that came after a lot of the buildings for sale being unpriced.
Wow, it's amazing changes. Kiyoshi, is it possible to share some thoughts on the market in Japan? Oh, I think, did we lose him? Maybe he tried to unmute and.
There he is.
Okay.
He's on a
Yoshi-
train, that Daniel.
Ah, okay. All right. Vincent, could we follow up with you? Vincent, you're still there, right? Your photo is gone, but I think you're still with us. I just wondered if you could share some thoughts. I know you shared some thoughts on the market generally, but in particular with respect to the industrial market and what's happening there, because of course you have also not only a domestic demand, but an international demand for your industrial facilities.
It's been the savior for us, especially during the pandemic. A chunk of our demand coming, especially last year, came from the industrial sectors. So companies are expanding a lot of our portfolios right now. I think, if I'm not mistaken, 20 to 30% of our portfolio right now are servicing industrial demands. Most companies are expanding, and yeah, it's pretty strong in general compared to the pre-pandemic scenario.
Well, that's good. It seems to be it seems to be a savior for most people,
Yeah.
frankly, the industrial market. Are there other thoughts to share with respect to your markets, things which may be happening, something of interest to share? Are you seeing, are the foreigners, the foreign investment, of course, the cross-border investors have been active in a number of these markets in Japan and the Philippines and in South Korea. Are they staying home? Obviously, they were slowing down because of the pandemic, and then I think they were starting to come back. But Mr. Kim, are there foreigners still around? Are you still receiving calls from foreign investors?
Yes. I've been busy working with US companies, but they found my company through web search. And I'm providing, tenant rep service, because I think some US companies want to lease some space to enter Korean markets, and yes, some mid-sized company, yes. I've been working with them since last October, and we done the transaction March, and I received another request from US asking me to provide the broker opinion of value. So I'm still working on it. So considering these requests, many investors considering, the entering South Korean market more than the pre-pandemic.
And Vincent, are you finding the same?
Yeah, pretty much the same. We're looking at yeah, the like I've said earlier, and a take up alone in Q1 around 145,000 square meter of office space in Metro CBD alone. On our side, we're finalizing two deals, two office deals from an American BPO. The other one is around 2,700 square meters, or around close to 29,000 square foot in Cebu. And we're also doing another deal with a BPO company in Metro Manila. So it's a mix. This we're about to finalize our rationale when it comes to the work from home setup. Would it be an 80-10, 80-20, 90-10, 30-70? And we're also seeing companies relocating at the outskirts of our metro CBDs. BPO companies relocating in Cebu, in Iloilo, on the southern part of the Philippines, and not just in Metro Manila.
And Vincent, while we're on the topic, the change in politics, as you said, you're having another Marcos.
Yeah, another Marcos.
Is well, you say that with a very moderate amount of enthusiasm.
Yeah.
But what
I
are the
voted for
expectations?
his opponent, so yeah, that's something that we're hopefully excited to look forward into. But that's yet to come. We're more worried on the next surge, which hopefully will not come. Because we had a lot of gatherings in the past couple of months, and we recorded a new variant here. Hopefully, there's no new surge.
Ray, of course, has asked about cap rates on industrial sales in each country. Vincent, while you're speaking, what are the cap rates on industrial sales in the Philippines today?
It's one of the highest right now. It's at 6 to 7%, compared to the office, which is around 4 to 4.5%.
Wow. Mr. Kim, in your market, industrial cap rates?
Around 4, I think, 4%.
Mason, what is it for you in Detroit?
Detroit, I think is a value compared to a lot of different places in the United States. Our cap rates for long-term net leased industrial properties are 6-7%. Office, for good office product on current NOI, you're looking at cap rates of 8-9%. So I've got investors that regularly invest in Detroit from California and other markets in the United States that see that as a real bargain.
In Switzerland, I would say office is 5, industrial 3, residential 2.
5, 3.
Sorry, that was,
2.
sorry, Daniel. It was office was 5.
Office,
industrial 3, residential 2.
Okay.
And that's pretty
So-
consistent. Yeah.
Residential market is very hot, right?
Yes, it remains hot. It actually in key prime locations, it could even be lower than that, but that's generally what you're going to expect to pay.
In Japan, Yoshi?
Cap rate of residential in Tokyo. Ordinary investor buy about gross cap rate about a small one, yes, about gross 5 or 6%.
Okay.
Yeah, and net cap price maybe minus gross minus 1.5%.
So
And
Was that industrial?
and some investor ordinary investor buy about 80 million to 100 million yen price range. And some big one by some fund by residential shop as in Tokyo about 3.4 or 3.6, and the office is 3.2 or 3.5. It's net coverage.
Okay, thanks. Thank you.
Are there other comments to share? Ray, other thoughts you have to share?
Oh, I probably talked too much already.
Mr. Kim, Vincent, Kiyoshi, other thoughts you'd like to share on your market or otherwise? If not, I will turn it over to Jonathan. to
Japan
give us-
market?
Sorry. Yes, Kiyoshi?
Yeah. Sorry. Can you hear me?
Yes.
Oh,
Yep.
a whisper voices on the train. Yeah. Japan's market market report from Japan. Yeah. Is three. One is in Japan, the ban of electric contracts has been lifted since yesterday. Everyone is happy because stamp duty is no longer regulated. And the two, much about the fiscal year and year end for money companies. But there were quite few cases where companies with poor performance in COVID-19, such as entertainment agencies and travel agencies sold their own buildings and lease back. And three, the soaring price of building material is very high, is serious, and some companies have estimated expiration date of 3 days. Yeah, for building work. Yeah, that's all.
On your last point, are you saying that inventories for building materials are 3 days, inventories are very low for building materials?
Or bids on prices they only hold a quote for
Surprise,
3 days?
Yeah.
Okay.
Actually, one more thought, Daniel, I will throw in the 52,000 foot warehouse where I don't think we're going forward with it right now. The clients in the air freight business, they've been growing like mad. They just bought a US company, fellows over to Europe all the time. His comment to me was that if we thought we had a crimp in the supply chain in the past, he said it's going to be worse over the next 2 years. And I think he was citing Shanghai with you mentioned 300 or 400 ships backed up. It's been good for him because he's in the air freight business, but he said we have not seen the end of this problem. It's going to be worse.
Thank you. Not that you're sharing good news, but thank you for sharing it. But that's very good insight, obviously. That we've got a long road ahead of us. If no other comments on market reports, and Jonathan, do you want to share what might be upcoming CORFAC views? I know we're meeting in Dublin, but maybe there's other things happening.
Yeah, I mean, and Mason can speak to this as well. You know, we're excited that the live get-togethers are starting to become more regular. I hope you all can make it to Seattle for our fall conference. It's a great location, and Jeff Crane, our partner there, is working on putting together an excellent program. Mason and I were on a call yesterday about a regional meeting we're going to have in St. Louis in about a month. And while our spring and fall conferences are important, we also feel having regional get-togethers occasionally is a good thing for those who might not be able to make it to the national meetings. Have something where it's within, a 5 to 6 hour driving distance for people to get to. And so far the response has been very good. So we're going to do that in St. Louis towards the end of June. And then Daniel, as you mentioned, looking forward to a nice turnout in Dublin in a couple of months for our European partners. Of course, anybody is welcome. We actually have a few US CORFAC members who are going to attend that meeting. And if anybody from Asia wanted to attend, of course, you're welcome for that. I think I mentioned early on this call that I'll be going to the ICSC convention on Sunday. And that's the largest retail convention in the US. And it's been a very, very good place for us to meet potential new CORFAC firms. And I have meetings with 4 or 5 firms there to talk about it. And we've also got several CORFAC existing firms that are going to be at the booth and have meetings with clients. And then finally, when we get into the fall, CORFAC will once again have a large presence at Expo Real in Munich, which is, along with MIPIM, is one of the, if not the largest commercial real estate show in Europe. So it's exciting to see things getting back to normal. Yeah, I mean, in the interest of time, that's kind of what's happening. Mason, I don't know if you have anything to add to that, but that's all I've got for now.
No, that was a good summary, and I'm looking forward to being in Dublin. I'm going to make the trip, and I'm looking forward to that gathering.
That's great. We're looking forward to seeing you.
Yeah, thanks, Daniel.
And just for the markets represented in Asia, I'd like to express that the market in Japan, in South Korea, and the Philippines are critical and very important markets, not only because they're domestically active, and we can learn from that, all of us, but also because they're internationally active. There's a lot of companies, American companies, European companies, which are active in your markets, and companies from Japan, South Korea, and the Philippines active here. So it's great to hear, and I just want to express all of our appreciation for this opportunity to get together and to learn what's in your market. I made the little silly comment that if I want to know what the weather is going to be like in here in 2 weeks, I asked Jonathan what it's like today in Chicago. But really the same sort of thing does apply because of our markets. There are waves and there are trends that happen, both economic and political as well. So it's very good to know what's happening in other markets. And once again, I thank our colleagues in South Korea, in the Philippines, and in Japan for joining, and Mason as well, and Jonathan. And just to express the privilege that Ray and I have jointly chairing the International Committee, it's a great opportunity to have these occasions to get together. And we're looking forward to them continuing regularly, of course. And lastly, from my side, if there's anything more that we can do, we're all ears. As Jonathan always says, what can CORFAC do for you? How can we help you? And we're keen to know and keen to do more. I thank everyone for joining. Ray, would you like to add anything, or Jonathan, or Mason?
No, well stated, well articulated. Thank you. Always a pleasure to see everybody and via Zoom, if not in person. This is terrific. Thank you.
Thank you to everyone.
Thanks, everyone.
Uh,
Bye.
Bye-bye.
Take care.